So one of the questions we get asked quite often is how people should buy a property. What would you consider?
So there's various things to think about, and as always, there's never one answer, but several options. First option that we'll talk about is if you have an existing trading company, the trading company could buy the property. That's a really simple way of doing it. The company may already have a good credit rating, which will help. Um, there's less cost involved in using an existing company. But there are risks associated with choosing the simplest option. The main risk being that if the trading company fails, then the equity within the property is at risk. So you basically have to sell the property to pay off the creditors. So it's often sensible to look at buying it through a different limited company. So that might be a company that you set up especially for the purpose of buying this particular property. Um, or you may look at setting up a holding company which would own the property and rent the property to the trading company. Trading company gets tax relief on the rent payments, whether it be to a holding company or a separate limited company. But the two companies in the scenarios we're talking about here would pay tax on the rent that they've received. But the equity in the property is safe from the creditors of the trading company.
And that would be with a commercial mortgage.
Yeah. Limited companies pay corporation tax at between 19 and 25%. So any profit that the holding company or rental company makes on the rent would be taxed at those rates. Also, unlike if you own the property personally, which we'll come on to shortly, companies can get full tax relief on any interest that they pay on any borrowings that are made to purchase the property. Another option is to buy the property personally rather than forming a limited company. That's a cheaper way of doing it. Also, you don't have to file accounts at company's house, so it's a more sort of confidential way of doing things. Problem with owning it personally is personal tax rates are higher than corporation tax rates, and also you cannot claim, or you often cannot claim tax relief on the full cost of the interest that you're paying. So I think individuals buying properties, whether it be commercial or residential, is becoming less and less frequent. And another question that we're asked regularly is, should I transfer properties that I own personally into a limited company? But that's a topic for another day.
What about if somebody was debating on purchasing one property or purchasing multiple properties?
Yeah, so I suppose if the plan is to build up a portfolio, then the additional costs involved in doing it through a limited company would ultimately be spread over more properties. So you've got to do a bit of a cost benefit analysis, really. So what's the cost of forming a company? What's the cost of running a limited company compared with how much tax I'm saving? And if you're just doing it for one property, then perhaps it's a little bit of swings and roundabouts. But if the plan is to invest in more properties going forwards, then the cost of a limited company would be spread over more properties and it probably becomes more economically viable.
I suppose it would also depend on the individual's personal tax situation as to whether they're a basic or higher rate taxpayer.
Yeah, a limited company does give you more flexibility with tax planning because you can choose whether to leave the rental profits in the company or you can take them out as a dividend, paying tax at whatever rate your other income is taxed at. Um, so limited companies give you a little bit more flexibility, whereas if you own the property personally, then you get taxed on the rent that you've received, irrespective of whether or not you spend it.
there any other options people could consider?
So another option would be if it's a commercial property, you could look at putting it into a pension. There's a lot of tax advantages to buying property through pensions. The main one being that the tenant, which could be your trading company, gets tax relief on the rent that's paid to the pension. But if it's in the pension wrapper, then the pension doesn't pay tax on the receipt of the rent. Also, any increase in the value of the property is tax free within a pension. It's only when you retire and start drawing your monthly pension that there's any tax payable on the rent or the increase in the value. So it's a very tax efficient way of doing it, and it's also the equity in the property is protected from the creditors of the trading company if you go down the pension route.
And it doesn't have to be your own trading company that you rent it out to?
No, it can be a third party. It doesn't have to be a connected party. You need to speak to a financial advisor before you go down the pension route. But yeah, it's a pension is a very attractive way of investing in property, very tax efficient.
Is there anything else anyone needs to consider when they're looking at property?
I suppose the other main consideration on commercial property, not residential, but on commercial property is VAT. So is the property that you're buying VAT registered? Will there be VAT to pay on the purchase price? You don't always have to pay VAT if the existing owner has not decided to opt to tax the property, then there wouldn't be VAT to pay. Also, if there is VAT on the property and it's a transfer of a going concern, then you can sometimes avoid the necessity to pay VAT on the purchase price. But you do need to think about whether or not the property should be VAT registered going forwards. And it can cause complications if you've got multiple properties, some of which are VAT registered, some of which are not, because reclaiming input VAT within that business gets a little bit complicated if you've got different VAT treatments in properties. So VAT is something that you need to talk to your accountant about, and it does sometimes catch people out. They don't realise that there's going to be VAT to pay, and they sometimes have to quickly find additional funding to fund the VAT until they're in a position to recover it from HMRC.
When people buy property as well, they can often look at capital allowances because there might be additional tax relief they can claim if previous owners haven't claimed it as well.
Yeah.
But that's something to discuss with a solicitor when you're purchasing the property.
Yeah, it's a really good point. Capital allowances are often missed when properties are purchased, and it can make a big difference to tax that's payable on the rent, certainly in the first few years of ownership.
Thank you very much. Drop that in.
It's fine.